Hello, this is Stephen Harris, the head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:45 a.m. Central Time, and I'm recording this in preparation for the market day of January the 8th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So, pretty interesting overnight. Let's go ahead and jump into our morning report. At times, we had it up about 20 points. Sorry about that. We had a little hiccup with our Adobe freezing up, but back to action with the morning report. At one point, we were up over 20 points. At the time of this cut, we were up about 8 points, or a little less than 0.5%. Russell's also up about 0.5%. NASDAQ up almost 2/3%, and the Dow up a little less than 0.5%. Crude oil down marginally, about 1/4%. The euro down a little over 0.5%. Bonds down about 1/4%, and gold down about 0.8. Overseas action, China has stabilized, at least for the moment, is up about 2%. Hong Kong up about 0.5%. Japan down about 1/3%. Germany essentially scratch, and the United Kingdom is just above scratch. In terms of macroeconomic reports for today in the United States, you have the monthly employment report. So that will be a very big deal, and that'll be about 45 minutes from now. So that could absolutely reset things going forward. In terms of our current volatility conditions, obviously a lot of action here of late. Short-term VIX a 26, and so this is quite a pop yesterday. Skew still up over 135, and that calls for 2 standard deviation moves at a much higher probability in the next 30 days, and that certainly has been living up to its probabilities of late, including yesterday. Yesterday we had 2 standard deviation moves put in on all 4 of the broad market indices. We continue to note just how frequent these big price moves have been of late, and right now our count is 7 out of the last 10 trading sessions in the S&P have been at least a 1 standard deviation move. Also of note, you notice the number of 2 standard deviation moves that have been put in by the various indices of late. 1, 2, 3, 4, 5, 6, 7, 8 different events across the 4 indices in the last 2 weeks, and much of that, frankly, in the last 5 trading sessions. So there's been quite a bit of price volatility. IV percentile, though, is still, frankly, not even to the midpoint. It's a 46 on the SPX, 42 on the Russell, 46 on the NASDAQ, and 46 on the Dow. So in big terms, you know, the amount of volatility that we have here in terms of IV percentile is not even hot yet. So kind of keep that in mind. In terms of our charts, let's take a quick look there. Pretty interesting pattern yesterday. Total confirmed breakdown of this all important level of support we've been talking about. And not only did it break through that, but it broke through in a big confirmation way with a 2 standard deviation move. Thus far today, and I'm on the futures contract because of the amount of overnight activity, we have something of a bullish harami forming. We'll see where that ends up for the day. Obviously, we still have one of the big 4 macroeconomic reports with the monthly employment report to come in, and then, of course, all the cash participants. So we got a lot of day yet to put in, but still, thus far, the overnight action is promising, which is in contrast to recent trading days in which so much of this was actually in the overnight, and then during the day, often we saw bounces, but still the next overnight would take us down another notch. Now, in terms of where are we going from now, we're due for a bounce. but is it just going to be a bear flag bounce and then we roll over and continue? That is one option. And indeed, when we break through the 618 fib, I kind of expect the fairly high probability that we're going to go back down to this 100% area. So that is probably the leading thesis at this time. That being said, I took a look at the prior times in the last 12 months or so that we've had hedge risk level 3. And there's actually been 4 events. One of those lasted for 8 trading sessions, one lasted for 3 trading sessions, and another 2 events lasted for 1 trading session. So you see, while we've still been in what's considered a bull market in the big picture, these opportunities, and then that's the word I think is probably most appropriate. Whenever you get down to the bottom of the range and fear seems to be running in the streets and so forth, the institutions and other significant players have used that as an opportunity to load up on a value proposition, and we've turned around. And indeed, if you look back at the prior events in this last year, so many of these bottoms have been V bottoms. And when you look at those V bottoms, you often have huge reversals. And in some cases, especially back earlier in last year, you would have 2 or 3 sessions and you'd be back to the top of the trading range. So I would say that this pattern and the way this is set up, my thesis A is that we're going to, continue to fall down and come down to this 1860 area. At the same time, I'm mindful of recent price action in this range-bound market, and so often we've seen a rip back to the top of the range. So 2100 is absolutely not out of the question if the bulls start to gain some energy and momentum. That being said, they're not likely to run into any kind of real resistance until they get up here to about the 2070 area. So just as fast as it fell through here, we could go right back up and get back to this 2070 area. So there's one option, and at that point we'd have to see, does it have enough energy momentum to continue past there to the 2100, to the 2110 and beyond, or does it just continue to range in this action? So thesis A, that we bear flag and then roll over, and people use any kind of a bounce as an opportunity to reload for bearish trades. Thesis B, that we continue all the way up to at least the 2070 area. So I hope all that was clear. In terms of the other indices, the Dow Futures are very much the same, with something of a bullish harami thus far for today. And the NASDAQ, very much the same. Boy, what a cratering of the NASDAQ we have had here of late. And then last, the Russell Futures, which had a very significant breakdown yesterday in that it broke not just, this kind of lower high, lower low that we had recent, but went through the August and September double bottom and broke through that in a big confirmation way. So we'll look to see, where does this go today? Does it regain the former area and this just becomes a similar bottom and a whipsaw and then back up here into the range? Or do we get a bear flag and roll over and this continues on to something far, far deeper? And you see, we have to go a ways back to be able to even find anything. And I think we looked at this yesterday, about the 1037 area, this action from October of a couple years ago as our next level of support for the Russell. So let's bounce on to our Vix Futures. And you see a big bounce up to 25 yesterday. A couple things of note here. If you go back and you count the prior times in recent history that we've been up around this 25 area, it has about 80% of the time been an area where a reversal has occurred in the price action of the broad market within a day or two. So obviously there are events where it continues. And in this case, went a few more days and popped up over 30, and we could go back further and see other extreme examples. But probabilities are that we're setting ourselves up for something of at least a near-term bounce. So kind of keep that in mind. You need to start watching for the evidence of these bounce patterns. And then bonds, this is another place where we could see evidence of a bounce, as bonds would be inverse in a normal correlation and would start to come back. And so far, all of these things are happening. The Vix Futures are coming down, the bonds are reversing, and the regular indices are moving up and with bullish patterns early on. Lot of day to see yet, but we'll see where all this goes. We are looking for that possibility. And it should be said that if you look at market posture, and we'll go ahead and go to the daily report. Let me do this in a little different order today. Here's the intermediate term market posture. And while all of these are severely or very bearish, and in the S&P is holding on to the very bearish instead of the severely bearish by the skin of its teeth, it's at a 20.4. Notice here also, though, that the market posture bullish cluster signal has fired on 3 of the 4 indices, and on the S&P, it's technically not fired in that it's not below a 20, but it is all but. So we would say that that's a pretty significant early heads up for a potential bounce formation coming into play. And so we're going to need to watch that. There's a lot of evidence coming that we are very, very oversold, and that at least a bounce and bear flag pattern would be setting up. In terms of the big picture, the market trend intermediate term phase opinion, still phase 5, the break of horizontal and diagonal support. Very, very ugly, very obvious thus far. In terms of portfolio investor posture, still universally ugly. IBD status, market and correction, accumulation distribution remains on both the S&P and the NASDAQ and E. GMI index also remains a 0 out of 6 with a full out sell signal. That author remains 100% in cash. Decision point scoreboard, no change from yesterday, but very, very ugly on the short term and very mixed on the intermediate term as well as the long term. Overall consensus of all this is that we are market in transition, but with a clear bias to the bearish side and a market that seems to be breaking down, though we may be setting up for a short-term bullish bounce. Intermediate term market posture, as I mentioned earlier, very bearish, but also a bearish sentiment line. So we expect the bearish moves to be longer and more pronounced than the bullish moves. So keep that in mind. Position sizing opinion remains at 0% for the portfolio investor and 50%. Actually, yes, 50%. And we should be up here in this 24 to 30 area as of the close yesterday. So we'll just call this a flat 50% or less on the active trader position sizing opinion. In terms of hedge warning status, we retain that level 3, the potential for a significant market breakdown is a much higher probability when you have a hedge risk level 3. You see the various warnings. It's a sea of red. A market decline, sharp increase warning. Vix Futures well up over 18, actually up over 25. We are in market in correction. We did have a ratio warning, so that is an early sign to look for a market reversal setup. We also had a spike. I forgot to put that in red, but we had a Vix spike fire yesterday, and that is another sign to look for potential market reversals. So obviously these volatility metrics can continue to climb, but most of the time when they hit certain extreme levels, they do turn, and that helps set up for a market reversal. So we're getting a lot of different signs coming in for our early tells that a market reversal could be called for. So skew continues to be elevated. Look at those bullish clusters. Look at this, New York Stock Exchange, new highs, new lows yesterday on the 1-month time frame, 1,106 new lows against only 40 new highs. Very, very, very much a breakdown yesterday. Did a lot of technical damage, and this will not be healed with one good bounce day. We've got a lot of room to be able to go up before we start to talk about dramatically lessening the risk to the hedge warning status and other things. Intermarket risk aversion indicator still 4 out of the 5 is risk off. You see the fear and greed index continues to drop and heading towards the extreme fear. It's now at 26. Yesterday it was a 35. In terms of special opinions, option income, cover calls, put selling, won't go into a lot of detail on all this. They're all outside the acceptable window to initiate new positions for novice traders. The best thing to do for novice traders at this point is to sit on hands and to prepare your watch list of things that you might want to enter when things improve. The other thing, of course, to do is to be monitoring your current positions and make sure that you have acceptable risk in place and that you initiate any hedges that are necessary where you are out of kilter. Be sure to beta weight your portfolio, understand what your risk profile is at various levels. Whether you're down 2%, 4%, even down to 10%, what would that do to your portfolio? And are you prepared for that? And is there something that you need to take action on, or at the very least be prepared to take action on? These are the times when you have those plans figured up and set up, and not in the heat of a falling market trying to figure out what to do and how much risk you have on. So let's go to, well, actually the sector specific, a sea of red, all but utilities, and even utilities, as you see, is starting to show signs of breaking down. And indeed, look, utilities, while it was the best performing yesterday, it was still down. And that's one of the things that we always got to keep in mind. These defensive sectors, still fall. Consumer staples down 1.27% yesterday, and for the month down 1.6%. Utilities down even in the 1 day and 5 day, though it is still holding up in the 1 month. For the 3 months, still down. Year to date, of course, that's just a week or so. You can see these various numbers. It doesn't matter when you have a bear market. Everything can fall, good with the bad. So always be prepared for that, though obviously, utilities is going to hold up far better than, say, information technology, industrials, or materials, those high beta areas that would be expected to really take a hit, and they certainly did yesterday. Okay, I think that's probably enough for today. As always, if you find that this is helpful to your trading, you can show appreciation for what we're doing and providing this free market preview each morning by subscribing to us on YouTube. And we particularly take note of, when people like us on YouTube, put positive comments there, and other feedback. Also, retweet us to your Twitter followers, to your StockTwit followers. That is our pay, as you might put it, by putting all this together and investing the time to share these thoughts with you. So all those things do matter. We do take note of each and every one. Some special opportunities here. I'm not going to take any more time today. We've been long enough, but I will scroll through these. You can see the slides and the hyperlinks and go for more information. If you're a day trader, this is a must-have product. Registering for this course at this time. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. You see the full hyperlink at the bottom. And for those of you who want to see all the legal jargon, you can just go to that hyperlink and you'll get pages of it. And we'll see you back here on Monday morning before the market opens with the market preview from Falcon Global. Good trading.